which is the inventories. Yeah. So I think that we have 2 weeks to cover for this topic, hopefully. Right, if it's only 1 week, we may not be able to really absorb the topic. But we'll see how we are doing, inshallah. Yeah. Okay. Again, for this topic, for those who already have the background, is a revision. And for those who do not have a background, right, make sure that you really understand this topic. Otherwise, you will have difficulty later when we do the assessment on this topic. Yeah. So, can you see the slides now?
Yes, madam.
Okay. So this financial accounting and reporting one, the topic is inventory. All right. So we are going to look into the definition, and then what is more important is that how to decide on the values of your inventories. All right. If you remember that you do have in your statement of financial position, you do have what we call inventories as part of your current asset. Yeah. So how do they come out? For example, you have at the end of the period, you have inventories of 5,000 ringgit. All right. So how you decide on that 5,000 ringgit of inventory? So this topic actually we look into the measurement of your inventories, and there are a few methods for you to identify or for you to determine or for you to calculate what is the value of your inventories at the end of the basis period, right? So for the definition, inventories are assets. I need to check that we actually are recording, right? So inventories are assets. So when we say that assets, it means that it's expected that it will generate benefit, right? It's an economic resources to the company that will give benefits to the company. And then, but these assets are held for sale, all right? It's not for you to use for you to generate economic resources for a long time, right? But it's held for sale in the ordinary course of business. So it means that when we say inventories, we are talking about companies that not the one providing services, all right? Because if you provide service means that you don't have inventories. If you have inventories, it means that you sell goods. Yeah, means that you do have something to sell. In this case, there are goods. And we have to purchase the inventories at cost. And then when you sell at profit. So the difference between your profit and your cost is what did I say? You sell at profit. So the difference between your profit and the difference between your sales price, all right, not profit. The difference between your sale price and the cost is your profit. Yeah. Okay.
Madam,
so yes.
Sorry to interrupt, but I think we haven't covered intangible assets.
All right. I purposely do not cover that today because we have actually passed that, right? And that is very short. So I will just give you a small recording on your intangible asset. And I know that we have not covered that topic, but it was in the midterm exam. So for our class, all right, the topic, the question on intangible asset will be excluded from your marks. All right. So I think that is in your multiple choice question because I have not formally covered the topic intangible asset. So I will cover inventory so that we are at par with other class. So the intangible asset, I will do a short recording on that. Is that okay?
Okay, madam.
All right. Thank you, dear.
Thank you, madam.
Okay. Don't worry about your midterm last time because those topic will be excluded from the assessment. Yeah, I will not take marks on that topic, intangible asset. Okay. All right. Inventories are held in the process of production. All right. So you can have manufacturing companies with inventories as well. So if you're talking about manufacturing companies, so these are the companies that manufacture goods or the inventories for the purpose of sales later, right? Or you can actually buy a ready-made goods, all right? It's already there in the market, so you buy at cost and then you sell at profit. in the form of materials or supplies to be consumed in the production process or in rendering of services. Right. Classification of inventories. Inventories are classified as current asset in your financial statement when the inventory is expected to realize the asset, right? Or intend to sell or consume in its normal operating cycle. It holds the asset primarily for the purpose of trading, and it expects to realize within 12 months period. All right, so when you have your inventory, remember that you buy inventory or you have your inventory for the purpose of resell. Right, so but the resale period normally is within 12 months period. You do not want to have asset or inventory that you hold for so long, all right, and then later, all right, you manage to sell, unless, all right, or there's an exception. We're talking about antiques, all right. So those antiques normally the value will go further up, all right, the longer you hold that, right. But again, depends if you are in the business of buying and selling of antiques goods, all right, so it will be a bit different because normally it takes some time for you to sell an antique. All right, example of inventories, we have good purchased by a retailer and held for resale. All right, so normally retailer will buy the goods from someone else. It could be a wholesaler, all right, that means that they buy in bulks or so that they can get the cheaper price, all right, the cost is lower, or they can buy from another retailer. Yeah, so that is also common. You can also have inventories in the form of land and property and other assets held for resale. So careful with this, because when we say land and property, normally this is your non-current asset. But when we say land and property is an inventory, you are referring to business whereby their objective is the buying and selling of land and property. All right, for talking about development company. So the developer, the land and the properties are their inventories. The land and property for a developer, for example, you're talking about Sandavi development, you're talking about Gatari, all right, these are companies, development companies, all right, the property investment, all right, so this company, the land and property is their inventories, it's not their long-term asset, yeah, so careful with that. And then we can also have your finished goods produced, for example, in the case of manufacturing company, or we can also have inventory in the form of work in progress or partially completed goods, right? This is also part of inventories, and materials and supplies to be consumed in the production process. So for part D and E, all right, you will learn this a lot more detail when you do your MAF. What is MAF? Management Accounting Fundamentals. All right, and next semester, I think that you'll be doing that course. All right, so you will learn a lot more on the manufacturing. All right, where you have the work in progress, and then you do have partially completed goods. All this lah. All right, how to measure all this. Right, but generally in financial accounting, we are looking at, okay, you purchase goods, and then how are you going to decide what's the value of the inventories at the end of the basis period. All right, when you have inventories, all right, it's very important to have control over the inventory. All right, good inventory is ensure that inventory purchase and sales are properly authorized and accounted for by the accounting system. All right, by ensuring that inventory is purchased with proper authorization. So when you have a system, all right, in order for you to buy an inventory, you cannot simply just buy. All right, you have to do some control over the purchase of your inventory, because you do not want to have too much inventory in the business, right? Because it's not good. It's not a good control when you have too much inventory, and you do not want to have no inventory or very minimal inventory that when customer comes in, want to purchase your goods, all right, you cannot deliver because you don't have inventory in your shop, right? So it's very important to decide how much inventory should you purchase and how much is the minimum amount that you need to know when you want to reorder your inventory, so that you do not have insufficient inventory in the company. Right? And it's also important for you to track and document receipt of inventory. Right, whenever there's a purchase, all right, you have to record the purchase of your inventory. And when there is a sales of inventory, all right, inventory goes out. So how are you going to record those in the accounting system? All right, and on top of that, you also have to record any damaged inventory. All right, remember that the inventory is not a long-term asset, right? Some of the inventory depends on the type of inventory, right? Especially if you're talking about you are selling, for example, you're talking about vegetables and fruits. So those are your inventory. And these are very, it goes obsolete very, very fast, right? So you have to record the damage, for example, or even if you're talking about canned food, yeah, so some of them get expires, for example, yeah, so you have to record those damages. Perform a physical count of inventory annually. So it means that at the end of the year, or not necessarily at the end, normally you decide a day or a few days for you to close the business in order for you to do a physical count. So when talking about physical count, it means that you do actually do physical counts of your inventory. All right, so sometimes we call it as a stock take. So sometimes you see that, okay, company is closed for stock take purpose. So when you do the stock take or physical count, means that you're going to count your inventory. All right, how much inventory you have physically in the company, and then you compare that with what is in your system. Right? Because remember, the system record what comes in, what goes out, but at the same time, you must make sure that what is in the system is also the same as what in the physical. Right? And of course, during the physical count, you'll find that some of the inventory may get damaged. All right, it could be out of expiry dates, for example. All right, so where you have to that you have to dispose of this inventory. So when you do physical counts, then you have to do something, for example, how to manage reduction in inventory, right? There could be a shrinkage of inventory as well, yeah, depending on the types of inventory. Recording and removing inventory from merchandise inventory when sold. So when you have sales, how are you going to record the sales of your inventory? And remember that when you sell your goods, right, remember that the inventory reduce. And inventory is an asset. So when you purchase an inventory, you're going to debit. And then when you credit, you sell the inventory, you're going to credit. All right. So these are the things that you have to learn in this topic. All right. Initial recognition and measurement. All right. Inventory shall be recognized and measured at the lower of cost and net realizable value. So these are the two things that you should know, all right, what we call as the lower of cost, all right, so this is one, or you are going to measure at the NRV, net realizable value. These are the things, yeah. What else? And then, all right, these are example of presentation and disclosure. All right, inventories are presented as an item of current asset in the statement of financial position. Remember that you have inventories. Non-current asset could be your property and plant, intangible asset, investment in your subsidiaries, trade, and other receivable. So you see that in the account, normally you have note to the account that will provide you additional information with regard to the asset that you have. All right, and then you have current asset. We have inventories here, right? Inventories note number 15, and what's the value of the inventories here. So the values here is what we have to decide. We are going to learn how to decide the ending. So this one inventories here as 31st December. So this is the ending inventories, ending the ending value, or what we call the closing, right? The closing figure of your inventories. And note number 15 will give you details of how you measure your inventories, all right, the method that is being used, all right, so all this is in the notes to the accounts. All right, how are merchandise inventory costs determined under a perpetual inventory system? So under accounting, there are two types of inventory system. Number one is perpetual inventory system. And number two, anyone can guess? One is perpetual inventory system. The other one is?
Periodic.
Very good. Periodic inventory system. All right. Both systems actually measure the value of your inventories. It's just that the method of measuring is not the method. All right, the method is different. It could give you different values as well. All right, the perpetual and the, but it's the same lah. It's the same value. It's just that the method that you actually use. Yeah. So ending merchandise inventory is the number of units on hand. It means that it's your what at the end of the period, all right, how many units you have times by the unit cost. So this is your ending inventory. All right. So it means that ending inventory means that in the company, how many units you have, and then times by the unit cost. Right, unit cost, then you have to decide what is your unit cost. So this is the thing that you want to look at. All right, I have to close this lah. Right, so unit cost here is the one that you want to assign the dollar, right? How much you are going to assign the dollar amount. So this is the one that you have to decide, right? And then assign how much, what is the value of your closing stock. So that is what you have to decide using different methods. Yeah. Okay. If you're looking at closing inventory or the ending inventory, look at what is in your hand times by unit cost. But if you want to know what is the cost of the goods that you sold, means that you remember you sell to your customer, but you want to know what is the cost of the goods that you have sold to your customer. Then you look at the number of units that you have sold, all right, times by the unit cost. Yeah. So there are two, all right, what do you call this? Under perpetual, you will have your cost of goods sold here, yeah, COGS, cost of goods sold, right? Whether it's under periodic, you also have the ending inventory that you have to decide. But when you see that the account have cost of goods sold, then you know that it's under perpetual, okay? So cost of, the name is cost. What is the cost of the goods that you sold, right? So it's very straightforward there. So we want to know the cost of the goods sold, then you look at the number, how many units that you have sold, and then times by the unit cost. Yeah. And then, all right, in this case, for example, how are merchandise inventory costs determined under a perpetual inventory system? So under perpetual inventory system is what is a perpetual? It means that the system records every transaction, right? It means that every time you purchase an inventory, it will be recorded. Every time you sell your inventory, it will be recorded. So it's a very detailed accounting system, all right, for your inventory. And normally, all right, the perpetual inventory system is used by big companies that have the accounting system, all right, that will manage to be able to record every transaction, every purchase, and every sales of the business, all right? So looking at this example, for example, on August 1st, you have cost of 2 units in hand, and each one cost you $350. All right, and August 5th, you purchase another 4 units. So initially you have 2 units in hand, now you have 4 units purchased, so total now you have 6 units. All right, so the opening balance plus your purchases during the period. So as of 5th of August, you have 6 units. Is that clear? 2 plus 4. And assuming that the cost per unit is $350, then you should be able to identify what is your closing inventory at the end as of August 5th. All right, so it means that when using perpetual, you'll be able to identify your closing inventory, the value of your closing inventory at any point of time, because why? It's under the system. All right, and then on the 15th of August, you sell 4 units, right? So before that, you have 6 units, then you sell 4 units, and therefore at the end of the period, you only have left with 2 units, whereby 6 units that you have minus 4 that you sold. So in hand, you now only have 2 units, right? And then on the 26th, you buy another 12 units, so 2 plus 12, then you have 14 units. And assuming that the cost per unit is $350, so you should be able to know what is your closing stock. How much is a closing stock? It means that the number of units you have, so in this case, 14 units times by the value 350 ringgit or dollar, yeah? And then you sell another 10 units, so initially you have 14, now you sell 10 units, in hand now you only have 4 units. So 4 units here is what we call your closing inventory. Right? So how to decide on your closing inventory is that the 4 units you have in hand times by the unit cost. So in this case, the unit cost is $350. So 4 units times $350, you get 1.4 or $1,400 as your closing stock. So that is your closing or your ending inventory. Is that clear?
Yes, madam.
Yeah. But when I talked about your COGS is the cost of the goods sold. So now you see that how much you sell, you had sold the first on the 15th of August, you sold 4 units, and on 31st of August, you sold another 10 units. So total units sold is 14 units, right? So 14 units and the cost per unit is $350. So your COGS is 14 times 350, which is 4,900. So in other words, it means that initially you have 2 units. During the period you purchase 16 units. So how many units you have? Total units that you have is 18 units. 18 units and then you sold 14 units. 18 minus 14 is 4. It means that in hand you should have 4 units, which is your ending inventory. So the computation is always there. You should know what your balance plus purchases during the year and then minus your goods sold, then you have your ending inventory. Does that make sense? Okay, all right. Any question with this? No. All right.
Madam,
Yes.
but 16 minus 14 is...
But remember you have balance initial in balance 2. On August 1st, you have quantity in hand, you have 2 already.
Oh,
2
okay.
plus 16, 18. 18
Oh,
minus
yeah.
14 is 4 lah.
Okay.
Careful with your opening balance, yeah? So these 2 units is your opening balance. It means that the inventory from July. So you carry forward to your August, so you have opening balance of 2. So 2 is what we call opening inventory and 4 is your ending inventory. Is that clear? Okay.
Yes, madam.
And then how are merchandise determined? So if your cost, all right, in this case, the unit cost per unit is very easy, 350 only, all right? But it's very unlikely that the cost of your goods remain the same over time, all right? Especially you're talking about month to month, right? Especially looking at the economic condition, looking at the demand and supply. So all these will determine the cost per unit, right? So when the costs are different for different groups of inventory, it's more difficult to decide which dollar amount to assign to the ending inventory. Yeah, so we are talking about how much, in this case, the value for your ending inventory, yeah, amounts to be assigned to your ending inventory. Why? Because, for example, in this case, August 1st, you have quantity, which is in this case, 2 units is your opening balance and the cost is 350, right? But then when you purchase on 5th of August, the quantity purchased is 4, but now the cost per unit is already 360. You see? So the cost per unit here changes, all right? It differs from one to another. And then when you bought on another 26th of August, you bought and the price increases to 380, right? So when you have a difference, so how are you going to decide at the end of the period, you have an ending inventory of 4. So what's value that you have to decide? 4 times by unit cost. How much is the unit cost? So this is what you have to decide which dollar amounts to assign to the ending inventory. Do you get that? So that's why you have to decide, all right, what is the ending inventory, what would be the dollar amounts to assign to the ending inventory. Yeah, similarly, if you say that you sold 14 units, you sold 4 units and 10 units, so what is the cost of the, you want to take the 350 or the 360 or the so you have here, you bought another 380, right? So the 10 unit that you sell and the 4 units here, which value that you have to use. You get that? Okay. So that's why they come up with the costing method, right? Inventory costing method. An inventory costing method approximate the flow of inventory cost in a business that is used to determine the cost of goods sold and your ending inventory. 4 basic inventory costing methods are allowable by GAAP. One is specific identification. Second one is first in, first out. We call it as a FAR1. First in, first out. And last in, first out, LIFO. And then we have the weighted average. For those who do not have the background, how are you doing so far?
Okay, madam.
Okay, Saida? Are you the one that answered just now?
Yes, madam.
Are you okay?
Yes, madam.
Very good. All right. So if you have difficulty, then just stop me. Yeah. Even though if you are from foundation, it's okay to ask me question. Yeah. All right. So these are the 4 methods that you have to know. All right. You be tested on these 4 methods. All right. What we call inventory costing method. How to decide on the cost of your inventory. So we have specific identification, FIFO, LIFO, and weighted average. Right, the first one is what we call a specific identification. Right, this method is very special because it says that inventory costing method based on the specific cost of particular units of inventory. Right, so used for inventories that include automobiles, jewels, and real estate. So we are talking about a specific identity method means that the cost, all right, of each of the inventory, all right, is very specific. All right, if you say that you're talking about automobiles, if you want to buy an automobile, let's say, example, if you want to buy what kind of car? Now we have the is it Proton at 70, and then you also have, for example, Honda Civic. All right. So the price of these are very very specific. All right. It depends on the value of the cost that the company purchase. Right. So we are going to take it's very specific. All right. Whatever the cost given that will be used for that closing inventory. Right. Or jewels is very specific. All right. So when you're talking about specific identification method, normally the inventory are very specialized. Right, you don't have all the jewels of the same design, right? And the weight of the jewels, you're talking about gold, right, is different from one to another, right? You're talking about real estate, these are the properties, yeah. Or we're talking about if you are a boutique, all right, you have a boutique, the cost of each clothing is very different depending on the material, yeah. So that's why you use a specific identification method. So example here we have August 15, we have 1 tablet sold and had a cost of 350 and 3 costs. We have 1 tablet sold cost 350 and the other 3 cost you 360. On August 31st, 1 cost 350 and 9 cost 380. So in this case, it says that it's very specific what is the cost of the tablet that you sell. Yeah, so it's very clear that, okay, on August 15, you sold 350. So where is it? So you have August 1st, you have units, is 2 units. So this August 1st is your opening value, all right, opening inventory. You have 2 units. So normally we do have 3 columns here. We have the purchases, how many is the quantity, how many units that you purchase. And when you purchase, you have to identify what will be the unit cost. And then from there, you have the total cost, all right? And then the second column, you have cost of goods sold refers to the goods that you sell, right? So how many units that you sell and the unit cost, for in this case, is very specific. So you're using specific identification and then you have the total cost here. And the final column is your inventory on hand. Similarly, you have the quantity, unit, and the total cost. So let's see that under specific identification, how do we decide on the COGS and the closing inventory? Alright, August 1st, you have opening inventory of 2 units. Alright, each one costs you 350. So 2 units times 350, you have total cost of 700. And on August 5th, you buy 4 units and each unit costs you 360. Right? So each unit costs you 360. Now you have 1440. So as of August 5th, you have 2 units that cost you 350 and you have 4 units that cost you 360. Right? The 4 unit is the one that you just purchased today on the August 5th. So far so good? Okay. And then when you sell, cost of goods sold, when you sell on 15, and it's clearly said that August 15, one tablet sold had a cost of 350 and the other 3 cost 360. So on August 15, you sell 1 unit that costs you 350 and another 3 unit costs you 360. So from here, you have a total cost of 1430. So this is what we say is a very specific. It tells you the cost of the good that you sell. Right? So it's good that because as long as you follow the information, right, you should do well. All right, now you have to look at the inventory on hand. So if initially you have the unit 350, all right, before that you have 2 units of 350. So when you sell 1 unit of that, so the balance is 1 unit of 350. Again, initially you have 2 units of 350, then you sell 1 unit. So at the end, you have 1 unit of 350. But the units 360, you have 4 units, then you sell 3 units, 4 minus 3. As a result, you have a balance of 1 unit that costs 360. Right? So you total out the cost here, then you have one closing figure of 710. Are you following?
Yes, madam.
Okay.
May I ask, madam?
Yes.
When the question asking us, they will give us the unit cost, right?
Yeah,
In the
if it's a
credit.
specific identification, they have to give you the cost, the unit cost, because the name is specific identification. So they have to be very specific about the cost of each unit sold. So that's why I say that specific unit is very easy because the cost is given. You don't have to decide what will be the cost. Is that clear?
Yeah, thank you,
Right?
madam.
So that's why it's called specific, because they will specify the cost of each of the units sold, right? So you can decide what will be the closing then. And then on 26th of August, you purchase another 12 units, all right? And that cost, each one costs you 380. So total cost is 4560. And when it comes to 31st of August, it says that you sell 1 unit that costs 350 and 9 units that cost you 380. So you have to take this cost, all right? So 26th of August, you purchase another 12 units. So inventory in hand, you have 1 unit at 350, 1 unit at 360, and 12 units at 380. When it comes to 31st of August, you sell 1 unit at 350. So do you have any more units at 350?
No.
No more. Because why? Initially, you only have 1 unit. Now you sell 1 unit at 350. So no more balance, or there's no more inventory that costs you 350. But then you sell another 9 units, all right, that costs you 380. So initially you have 12 units of 380. So now you sell 9, 12 minus 9, you have balance of 3 units at 380. I remember that you still have 1 unit of 360 which is unsold, which is still in hand, right? So you still have to put that as your balance, where you have 0 unit of 350, but you have 1 unit of 360 and 3 units of 380. So you total up the cost, you have a total cost of 1,500. So the 1,500 is what we call your closing inventory or your ending inventory. Okay? And for the cost of goods sold, you have to total up each cost in there. You have 1,430 plus 3,770. That will be 5,200. For the 14 units, your cost of goods sold is 5,200. Right? For that period, you only want to take the totality. The COGS is 5,200. Your ending inventory is 1,500. And your purchases, all right, total purchases during the period is 6,000. Are you clear? Yeah.
Yes, madam.
So that is a specific identification method. The second one is the first in, first out method, right? First in, first out, or normally we call FAR1 method. Assume that the first unit purchased are the first to be sold. Right? Remember, the word is assume. Right? It doesn't mean that that is the actual unit that is being sold. It's assume that the first unit that you purchase is the one that you sold. So it's on what we call it is a conceptual, right? It's not that every time you sell the good, you must make sure that okay, the goods is the one that you first purchase, right? So what is the physical sales, all right, is not actually reflected in the accounting. You do not know, for example, all right, because the one who actually doing the accounting and the one that actually make the sales are two different persons. You do not know actually when you sell the goods is actually from the first that you first purchased, for example. Yeah, so you may not be able to identify the goods. But normally these goods are of the same category, so that's why you can decide the cost. So we always assume that in accounting, all right, when you say first in, first out, we assume that the first goods that you purchase are the one that will be sold in the recording, right? And cost of goods sold is based on the oldest purchases. So it means that because we assume that you sell goods that you first purchased, so the cost of goods sold is based on the oldest purchases, and your ending inventory closely reflect your current replacement cost. And cost of goods available for sale is the total cost spent on inventory that was available to be sold during a period. So now we also have another term, what we call cost of goods available for sale, right? GAS. For goods available for sale is actually your opening balance plus your purchases. So once you have the goods opening balance, so you have 2 units opening, right, and then you purchase during the period, so that will be your goods available for sale. Yeah, so opening balance plus your purchases, that is your GAS, your goods available for sale. Yeah. All right. First in, first out method. Let's look at an example here. Right. So on August 1st, you have 2 units cost you 350. So total cost is 700. When you on the 5th of August, you purchase 4 units that cost you 360. Right, so the balance here, you have 2 units at 350, which is the opening balance, and then you have the new purchases of 4 units at 360. So as of August 5th, you have 2140 closing inventories, or what we call ending inventory. So far, so good? Yeah, it's still the same. So don't forget your opening balance, yeah? And then when you have on the 15th of August, remember this one is first in, first out. So you sell 4 units, right? So you have to decide what would be your unit cost under FAR1. When you sell 4 units under FAR1, it's assumed that you are going to sell the first units that you have. So it means that the first unit that you have is the 2 units at 350. Look at the row before this. Right, the balance before the sale is that you have 2 units at 350 and 4 units at 360. So when you sell 4 units, then you're going to sell the first 2 units at 350 and the balance 2 units at 360. So you're going to use the top first, right? The first purchase inventory, right? You sell that one first. So in this case, 2 unit at 350 is 700, 2 unit at 360 is 720. So total cost of goods sold is 1420. So what is the balance? Remember that 2 units now you already sold at 350, right? The unit that cost you 350 sold, so you don't have any more units at 350. But the 4 unit at 360, you sold 2 units, so the balance is 2 units at 360. Are you following? Okay. And then what else you have? Then you purchase another 12 units at 380. So the balance now you have 2 units at 360 plus 12 units at 380. So on 31st of August, when you sell 10 units, all right, so you're going to sell the first 2 units at 360 and the balance is at 8 units at 380. So because of that, you have a balance of 4 units at 380. So total closing inventory is 1520 and your cost of goods sold is 3760. And again, these are your 6,000 is your purchases. So what would be your, okay, my question is, what would be your goods available for sale for the month of August?
700.
700? 700 is your opening balance, so it means that you are, what is the total cost of your goods available for sale? Will be your opening balance 700 plus your purchases during the period, right? Your purchases during the period is 6,000 plus 700, that will be $6,700. That will be your goods available for sale. This is the cost of goods sold, and this one is your closing or your ending inventory. Okay, question for your first in, first out. No question? Very clear? So it means that if you are being assessed, it's expected that these are the format that you have to do, right? In your exam, you have to have that column, purchases, cost of goods sold, and inventory on hand. And you have to show the perpetual. It means that you have to show every transaction and what's the balance at the end of the day. Yeah, so this is what we call perpetual. It's very detailed, all right? It requires you to list out every items, all right, accordingly. So that's perpetual. So how to record, all right, when there's a purchase, all right, and then you do have purchases and you do have sales, right? How do you record all these transactions? So when you purchase, all right, you are going to debit your inventory, right? So when you purchase 1440 on August 5th, you're going to debit your inventory account. So remember, under perpetual, you're going to have inventory account. Inventory is an asset. So whenever you increase your asset when you purchase, it means that you increase your inventory. So you debit your inventory accounts and credit your accounts payable. In this case, we assume that you purchase on account. Is that clear? So remember, this is a perpetual, yeah, not periodic yet. This is perpetual, debit your inventory, credit your accounts payable. So when you have make a sales on the 15th of August, how are you going to record that? All right, remember that you have to record two things. Yeah, one is the cost of goods sold, the other one is the sales itself. Right? So you have to record accounts receivables. In this case, we say that you sell the item. Where's the information about the item? It's not said here, but the example here shows that you're going to record account when you make sales, right? When sales is always sales at the selling price, right? So when you want to recognize how much your sales for the item, in this case, we assume that you sell 4 units at $500 each, right? $500 is not the cost. $500 is the selling price. So that's why we are going to receive that from your accounts receivable, your customer, right? Your debit, your accounts receivable, and credit your sales revenue. So sales is always on the credit side because that increases your honest equity, right? In this case, again, the sale is on account. The other transaction they have to record is on the cost of the goods sold. Remember, the first one is the sale, the second one is the cost of goods sold. Yeah, so what will be the cost of the goods sold on the 15th is 1420. Is it 1420? Yes. So cost of goods sold, it means that you're going to debit the account called COGS, right? The cost of the good that you sold is 1420, and remember that when you sell the goods, you're going to credit your inventory, and when you have credit your inventory, you are going to record the cost of the inventory that you sold. So that's why we record the credit inventory 1420. So remember, inventory is always at cost, but when you make sales, all right, remember that that will be the selling price. Okay, let me ask Nurul Ain.
Yes, madam.
Can you differentiate between cost of goods sold and the selling price?
The selling price is cost of goods sold plus the profit.
Yes, very good. So the selling price is always right, the selling price. All right, it's always when you sell, of course, you know the cost, because when you do business, you want to make profit. All right, you cannot sell your goods at your cost. Otherwise, you don't have profit, right? So that's why your cost could be 360, but you sell at $500. So that's how the difference here, the $140 is your profit for each unit sold. Okay, so remember that under perpetual, when there is a sales of your inventory, you have to have two recording. One is records of the sales itself at selling price. And of course, you're going to debit your account receivable, or if you sell on cash, you're going to debit your cash. The second one is to have to record your cost of goods sold, and you're going to credit your inventory. Why you credit your inventory? Fadila, why you credit your inventory?
Because our inventory is reducing.
Yeah, very good. Okay, thank you. All right, and then when you have on the 26, what would be the 26? You purchase 4560. So whenever you purchase, you debit your inventory account, credit your accounts payable. All right, assuming that you purchase your inventory on account, so you debit your inventory, credit your accounts payable. And when you sell another units, all right, 10 units on 31st of August, so you're going to have two recording. One is the account receivable. In this case, again, it's assumed that the selling price is $500 per unit times by 10. So that's your 5,000 debit account receivable, credit your sales revenue. The other one, you have to record your COGS, cost of goods sold, and how much is the cost? The cost is 380. Yeah, so 3,800 is your COGS. So debit your COGS, credit your inventory, 3,800. Right? Okay. Kenapa ini LIFO? Journal entries under LIFO? Kenapa kita boleh sampai ke sana? Oh my god. Okay. Which one did I show you just now? 1420. Kenapa I pergi ke LIFO Did I wrongly? Okay, again. Let's see again. Okay, let's look at your sales, no problem. On August 15, sales is 2,000. But the COGS and the first in, first out, the first one is 1420, so you record 1420. Is that okay? I do not know why I was under LIFO just now. All right, I apologize for that. It should be, we are doing now FIFO, first in, first out. So the COGS for the first one is 1420 and the second one is 3760, right? So how you get that? Because you're using first in, first out. So you assume that you're going to sell the goods based on the first purchase, right? Depending on the balance before that. Right, last in, first out, right? So this is another method. So method number 3 is your last in, first out. Last in, first out, it means that inventory is sold, the cost of the newest item in inventory is assigned to each cost as cost of goods sold. So again, it's an accounting, it's a concept whereby under the LIFO, last in will be first out. So you have to look at the balance, right, at the end of each day, and then what is sold in the net sales is that the last in will be first out. Right, cost of goods sold closely reflect current replacement cost, and any inventory contains the oldest costing cost. Yeah. So let's look at the LIFO here. Using the same information, you start with a balance of 2 units at 350. Then you purchase 4 units at 360. So you still record the balance in hand. 2 units at 350, 4 units at 360. The difference is that when you sell, all right, 4 units on August 15, you have to decide the 4 units come from which what is the cost of the 4 units? So you have to look again. All right, you have a balance here, last in, first out. So the last in is the 4 units. All right, 2 units and 4 units, which one is the later? Later is the 4 units. All right, so the last in is actually the 4 units. So the 4 unit is the first that you go out. So that's why the 4 units that you sell, you're going to take that from the 360 cost. Yeah, are you clear?
Yes, madam.
All right, so the balance, all right, you have sold the 4 units, so it means that the balance you have is the 2 units at 350. So when you purchase another 12 units, you have 2 units at 350, 12 units at 380. So when you sell 10 units, again, you have to look at here. All right, you have 2 units is the earlier and the last in is the 12 units. So last in, first out, you're going to sell the goods, right? Not sell, means that the accounting is that you're going to take the one from the 12 units, the 380 cost. So when you sell 10 units times 380, so you have 3,008 is the cost of goods sold. All right, because of that, you have the units to 350, which is the unit that you first purchased, is still in the account. But the later unit, all right, you only have 2 units at 380. Right, so that's the difference between last in, first out and first in, first out. All right, you see that the closing inventory is 1460. What was the closing inventory under 54 just now? Right, 54, the closing inventory is 1520, right? So because why? If you look at the price here, right, the price increasing from 360 to 380. So your closing stock reflect the latest stock, the latest inventory. All right, means that you normally will have a higher inventory cost. Yeah, and the first in, first out, because it reflects your ending inventory is the most current purchases, which is the more expensive one. Right, but the cost of goods sold is lower because normally you sold the good that you first purchased. It means that you sell goods at the unit cost of the earliest. So the earliest is always the cheapest. So your cost of goods sold will be the lowest, but the inventory will be the highest, right? But if you look into your LIFO, the difference is that your inventory in hand is 1460 because it represents the oldest unit cost, right, which is lower. Your cost of goods sold will be high, 5240, right? Simply 5180. So why is it very more? The cost of goods sold is higher because, all right, it reflects the more recent purchases, which give you a higher unit cost. So that's why your cost of goods sold will be higher under LIFO. But your cost inventory in hand will be lower because it represents the old cost which is still not sold. Yeah, the older cost is the cheaper or the less unit cost is lower. Can you see the difference? So if you have your first in, first out and last in, first out, you see that the value of your COGS and the value of your closing stock is not the same. Yeah, so it will have an effect on your profit later, right? So, all right, in terms of the LIFO, in terms of the journal entries, it's the same. It's just that the value is different, right? Where you purchase your inventory under Perpetual, you debit your inventory, credit accounts payable, and then you make sales. You have 2 recording. One is on the sales revenue, the other one is on the COGS. And remember that the cost of the COGS must be reflected when you do the computation, 1440 and 3,800. Okay, all right. Are you okay? Now you have your specific identification method. We have done your FIFO. We have done your LIFO. So far, so clear?
Yes, madam.
Okay. Well, now let's go into the last method, which is the weighted average. Weighted average method, all right, computes a new weighted average cost per unit after each purchase. What does it mean by weighted average? It means that the average cost. All right, so how do you get the average cost? It means that the total cost divided by the number of units, then you get the weighted average cost. Yeah, so the weighted average method computes a new weighted average cost per unit after each purchase. So they are combining the old cost plus the new cost, so you get the average cost. Does that make sense? Yeah, so how do you get the average cost? Total cost divided by the number of units that you have. It is determined by dividing the cost of goods available for sale by the number of units available. And remember that goods available for sale is your opening balance plus your purchases. Ending inventory and cost of goods sold are based on the same weighted average cost per unit. So it's very important to get the right weighted average cost. So if your weighted average cost is wrong, then the whole computation will be wrong. Okay, let's look at the example here. All right, so August 1st, you have units, 2 units times by 350. All right, so that is your opening inventory. And then you purchase another 4 units at 360. All right, so how many units now you have? You have 2 units plus 4 units. So total units you have on August 5th is 6 units. So how you want to compute your average cost? Right, what you do is that for average cost, you want to compute the unit cost, you take 350, which is the 2 units at 350, right? So total cost is 700. 700 you plus with your purchases of 1440. How much do you get? You get 2140. So this is the total cost, which is actually your opening cost plus the purchases. So you get 2140. How many units you have? 2 plus 4, so you have 6 units. So divide by 6, you get per unit cost is 356.67. All right, so far, are you following?
Yes, madam.
Yes, madam.
Okay, Slightly student confused, student will have difficulty to decide on the average cost. All right, if you're not careful, especially if you don't take into account your opening balance, right, you may get it wrong. But if you're careful, then you have the opening balance plus your purchases, get the total cost divided by the number of units, so you should get your average cost. So the 356 now is the unit per cost, and each one is for the 6 units. So when you make sales on the 15th of August, how many units that you sell? 4 units. And the 4 units, you're going to use the average cost that you just computed. Yeah. So the average cost is 356.67 times by 4. You get total cost of 1427. How many units left? 6 units minus 4 units sold. Then you have 2 units left times by 356.67. That's how you get 713. Okay, and when you purchase another 12 units on August 26, right, you have balance of 2 units plus 12 units. Now you have how many units? You have 14 units. What will be the total cost? 713 plus 4560. Do you get that? Right, so the 2 units have cost is 713 plus the newly purchased, you have 4560. So total is 5273. Divided by the number of units you have is 40, 2 plus 12. So now you have an average cost of 376.64. So you see that the cost, unit cost is different now. Yeah, so using that average cost, when you have a sale of 10 units, so you use the new average cost, right? The new weighted average is 376. So you times by 10 units, then how you get 3766, right? So now your cost of goods sold is 5193, and the balance for units is at the average cost 376.64. So if you look at the average cost, unit cost, all right, it always changes every time you have a purchases. You have to recompute your average cost. Yeah, so it's good to have this, right? Even though here purchases is still, because purchases is based on how much you purchase the inventory, but the cost of goods sold depends on the unit cost using the average method. Alright, similarly, your inventory in hand, the cost per unit depends on your average method. So that's why the figure is different. Okay, question on your average method. Okay, remember the format is that you have the purchases column, you have cost of goods sold, and then you have the inventory on hand. Okay. Alright. Weighted average method. After each purchase, Smart Touch Learning computes a new weighted average cost per unit. For example, on August 5th, the new weighted average cost is the total cost divided by the 6 units. Under the weighted average method, the cost per unit is a weighted average. You cannot take the average of the 2 unit costs, 350 and 360, to determine the new cost. You must use the total cost of goods available. Remember the opening balance plus your purchases divided by the number of units available. So I think I explained this earlier, right? So this one is also the same, where you take the total cost divided by the number of units. Right, journal entries is the same under Perpetual. It's just that the difference is that when you record your cost of goods sold will be 1427. Where do you get 1427? That is the first cost of goods sold, all right, 1427. And the second one is 3766. Yeah, the second per sales is 3766. Of course, the selling price, when you've got the account receivable and your sales revenue, depends on the selling price. Okay. So that is under weighted average. The journal entries are the same. When you record the inventory, accounts payable on purchase of your inventory, and then record the sales of your inventory at the selling price, and the cost of goods sold, all right, remember is at the unit cost using weighted average, right? And then this one again, you purchase and then you sell and record your cost of goods sold. How are financial statements affected by using different inventory costing methods? So remember just now we look into your what do you have? You have the average, the LIFO and FIFO and the average, right? So under statement of profit or loss, so you have the cost of goods sold. So cost of goods sold is actually your sales minus COGS. Yeah. Remember COGS under FIFO, and then you have to compare under FIFO and LIFO. If it says cost of goods sold, you know that, and the COGS goods sold is the first one under FIFO. So if it's under LIFO, your COGS will be based on the recent value. Yeah, the recent purchases, which normally a higher cost. So that's why your COGS under LIFO will be higher. Right, when price is increasing or when costs are rising, then COGS under LIFO is higher than your FIFO. Remember that your sales minus COGS. So if your COGS is high, then profit is smaller. Okay. All right. Can you check first, because I have to attend to hold on, yeah. Give me I hope not more than 10 minutes. I have to leave for a while, right? So what you want to refer to? Where's the slide? Okay, try to. Terus saya tak nampak. Right? Please go into this and try to imagine your sales minus COGS is equals to profit, and how do you actually get this? Yeah. Okay. I'm back. How much time did I take? All right, we have about 5 more minutes. All right, so I want to show you how. Okay, hold on, yeah. Okay, so look at this comparative between your, you have two statements, yeah. One is your statement of profit and loss that shows you cost of goods sold, right? And this, you will have sales minus COGS. You have your profit. We call it as a gross profit. Yeah, so that's the sales minus COGS is your gross profit. In your financial position, you are going to show the closing inventory as the value for your inventory under your statement of financial position. So in your income statement, right, you have your sales is the same under any method because it's assumed that your sales is 500 ringgit per unit. Right, so you show me the sales revenue is 7,000 across the board, right? Whether you're using specific identification, FIFO, LIFO, or average, yeah, weighted average. But the cost of goods sold is different because it depends on the method. So you see that here FIFO is the lowest. Why? The cost of goods sold is based on the oldest inventory, yeah. The oldest inventory normally have the lowest price. So that's why the cost of goods sold is the lowest. For your LIFO, right, the cost of goods sold is the most recent. The most recent under normal circumstances of price rising. So normally we talk about the normal economic condition whereby price increases from time to time. So under the normal price rising, right, you will have LIFO have a higher cost of goods sold because the cost of goods sold is taken out from the most recent purchases. Is that clear? The difference between FIFO and LIFO in terms of COGS. And of course, we're talking about weighted average is normally is the middle one. Yeah, number one average, right? So normally it's in between FIFO and LIFO. So if you look at the difference here, not only on the value of cost of goods sold, but your gross profit will also be affected. All right, your gross profit FIFO, because you have the lowest COGS, all right, it will give you the higher gross profit. Right, your gross profit is 1820 because your COGS is lower. So lower COGS means that higher gross profit. But under LIFO, you have a higher COGS means lower gross profit, right? So again, for companies, whether they want to adopt FIFO or LIFO, I think that the most commonly method used is the FIFO. Yeah, first in, first out, because that is the common. And the right, you are actually representing the fair value of your inventories based on the sales or the cost of the inventory under a normal rising prices. Yeah. Right. Your statement of financial position. Remember your you have beginning inventory, and then cost plus your purchases minus your COGS. So, all right, sorry. This is again, yeah, your beginning inventory plus your purchases. This is what we call goods available for sale. And from goods available for sale, you sold, right? This is your cost of goods sold, and this is your ending inventory. From available 6,700, you sold 5,200, so your ending inventory is 1,500. Similarly, for FIFO, all right, you have beginning 700, then you purchase 6,000. If you look at here, all right, the opening balance is always the same. All right, purchases is also the same depending, because the cost under every method, the cost of their purchases is the same. What is different is the unit cost when you sell. Right, your cost of goods sold available, goods available for sale is your opening plus your purchases. So in this case, you have 6,007, 6,007. So it's the same. But what makes the difference is your cost of goods sold depending on the method that you apply. So cost of goods sold, as mentioned earlier, the FIFO is the lowest. So that's why your ending inventory is the highest. Right? because ending inventory represent the value of inventory based on the most recent purchase, which is normally the higher cost. So that's why your ending inventory is highest under FIFO and lowest under FIFO. Highest under FIFO, lowest under LIFO. Again, LIFO ending because cost of goods sold is the most recent, which is the higher cost. So your ending is the old costing, right? The earlier cost, which is the lowest cost. So that's why your ending inventory under LIFO is lower, right? And weighted average is always in the middle. Okay, effect on the financial statement during period of rising and declining of inventory. Cost of goods sold depends because it depends on the specific identification cost of each, right? So under cost of goods sold, FIFO has the lowest COGS, LIFO has the highest, and weighted is the middle. The net income, because COGS is the lowest, net income is the highest. Under LIFO, COGS is highest, therefore net income is the lowest. Right? Balance sheet, right? Because ending inventory under FIFO is the most recent, they give you the highest. LIFO ending inventory is the old cost, right? The older cost, so that's why it's the lowest. Period of declining inventory. So normally this is the rising inventory cost, but the declining will be the opposite of it. Hello? Okay, so don't get you just remember the top one, all right? Otherwise, the declining inventory will be the other way around. So just remember the first part, the period of rising inventory cost. So if the question asks for the declining inventory cost, it will be the opposite of it. Yeah. Right. What is the time now? Okay, it's finished already. So I will stop here. How is merchandise inventory valued, right? Using lower of cost or market value. So we go this into in the next class. So in the meantime, please look into your tutorial question. I have shared that in your Google Classroom, right? So let me see your inventories. All right, where is it? Inventories. All right, tutorial question. Please do the tutorial question before class, next class. Can you do that? All right, so this one is using Perpetual. All right, so you're required to do Perpetual inventory system and then two methods, FIFO and LIFO. Journalize the transaction and prepare a comparative statement of gross profit for the year ended using the two methods. So methods here, we are thinking that is the FIFO and the LIFO. Is it? Yeah. All right, use the two methods, FIFO and LIFO. The question number 2, perpetual inventory system, and then using FIFO, LIFO, and average method, compute the gross profit for the month. It means that you have to show me the revenue minus COGS. Then you have your gross profit, and then at the end you have part C we have not covered, yeah. So the NRV. Oh, you already have the answer here. Wow, this is good. But try to do the question first, and then only check the answer at the back. Yeah, please do first, and then only check the answers. Right? You are not doing that for me. You are doing it for yourself. Is that clear? Okay, before you, you can leave the group, all right? And then don't forget to fill up your attendance form and give feedback on today's class. And if you need to do the watch again the video, I will always post it later in the Google Classroom. Any question before we leave? No question?
No, madam.
No, madam.
So I think that's all for today. Thank you for your attention. Right? I hope that you do actually get what we have discussed today. I hope that for those who don't have a background, all right, I really hope that you